Anyone who's looking at buying a house in Toronto's suburbs knows that the suburban housing market is on fire. But has the market gone from just a very hot and competitive market to a full-blown housing bubble? I think it has, and today I'm going to walk you through why I think so. Now, the last time I called Toronto suburbs a bubble was in 2016, and within 1 year, house prices had fallen 20%. So what I think I do today is walk you through what makes today's market a bubble, why it's completely different from what we saw in 2016 and in 2017, how it might end this time, and some of the key trends that you should be keeping an eye out for if you're actively looking at buying a home to protect your interest, ensure you're making informed decisions. My name is John Pasalis from Realosophy Realty. You can catch all my latest writings on our blog, movesmartly.com. If you find this video helpful, please hit the like button to subscribe to this channel to stay up to date on all my latest videos. So I first hinted that the trends we're seeing today are bubble-like a couple of months ago in November. And at the time, the average price for houses in the suburbs was about $1,050,000. And within 2 months, in January, the average price has gone up 16% to $1.22 million. Now, we don't normally compare house prices from 1 month to the next because prices can change for seasonal differences, but between November and January, house prices normally don't change very much. The averages generally, historically, have been pretty constant. So what we're actually seeing on the ground is a rapid increase in prices. And how can average prices go up $150,000 in just 2 months? Well, anyone who's looking at homes is seeing that. Anytime that they're bidding on a home, every house is selling for $50,000 or $70,000 or $80,000 or $100,000 or $150,000 more than what it's worth. And when you have a lot of transactions like that, that fuels house prices up even higher. Now, when we compare house prices in January on a year-over-year basis, which was what we typically do, average house prices in Durham, Halton, and York regions are all up over 30%. Peel region's up 29%, and the city of Toronto is up only 15%. Now, this is kind of why I feel like it's a suburban market bubble, because what we're seeing in Toronto is not quite as aggressive as what we're seeing in the suburbs. Now, this is not just a one-time event that prices are up 30%. I mean, this trend has been going on since the beginning of 2020. House price growth has been accelerating. I mean, it took a small dip in March and April and May during the lockdowns, but we can see from this chart that this is a year-over-year change in house prices in the suburbs, and that they've been accelerating pretty much for the entire year and really picked up over the past couple of months. Now, the next question, of course, is, well, what makes this market a bubble? Now, when economists, if you look at the literature, there's generally two conditions that make a market a bubble. And the first is that house prices are higher than their fundamental value. And economists generally measure this by comparing house prices against incomes and rents. And then the second condition is that if they are higher than their fundamental value, that this is driven by what economists call behavioral factors or irrational exuberance that's bidding these prices up. So when we think about what this means in plain English, it's the first part where we think about if prices are high relative to fundamental values. This is probably the condition that I think trips up most economists and housing analysts. Most economists or housing analysts who think that house prices being high relative to fundamentals means the housing market is a bubble. And this isn't true. House prices in a given city can stay high for a very, very long period of time, and it doesn't necessarily mean it's a bubble. And Toronto, for the most part, has been a good example of that, at least the past few years. And it cannot be a bubble, because imagine if house prices are high, but house prices are increasing only 2% a year. So in a sense, in that type of market, we think of the market as an overvalued market, but not a bubble, because bubble has this additional condition that the growth is usually explosive, and it's really driven by these behavioral factors. So what do we mean by sort of behavioral factors and irrational exuberance? You know, when we look at what drives those types of behaviors, usually there's a couple of things. The first is, you know, investors a lot of times jumping into the market, overpaying homes, not caring about the rent that they're getting on the property, but they're investing in it because they simply believe that the house is going to be worth 10 or 15% more in the future. And this is really the dynamics that drove the housing bubble in 2017. And then the other sort of scenario is when this overconfidence is from end users. When end users, and this is probably what we're seeing today, when they start overbidding for homes. And home buyers start overbidding for homes based on this belief that if they don't buy the house that they want today, in 6 months, it's going to be $100,000 more expensive, and they're never going to be able to afford it. And this is generally probably the dynamic we're seeing today in today's housing market that's driving house prices up higher and very rapidly. So when we think about, so that's kind of generally the two conditions. Now, the other sort of scenario I should point out is that, and I kind of touched on it earlier, when we have an overvalued housing market where prices are pretty stable. Now, in a condition like that, if we think about how house prices change in a given market from one year to the next or 1 month to the next, generally they're pretty stationary. I mean, if the average is 6 or 7% price growth, they might be, in that range, plus or minus 4, 5, 6% in any given month. So, if we think about how house prices change from 1 month to the next, we expect them to be relatively stationary. We're not going to see prices up 20% 1 month and down 20% the next. House prices are usually not that volatile. But once we see house prices deviate significantly from their long-term trend, and they keep accelerating further and further away from that, well, then we think of this as a sort of explosive growth in house prices. And this tends to be a sign of a housing bubble. Now, if we look at a chart to see what this looks like, this next chart shows the year-over-year change in house prices for houses in the suburbs of the GTA. And if the gray band kind of represents sort of the long-term trend that we'd expect house prices to be increasing by, we can kind of see that in sort of the first part in 2017, and even currently, once that sort of acceleration in prices started deviating further and further away from the long-term trend, well, those are trends that are typically indicative of a housing bubble. So the next question, of course, is, well, how is today's bubble different from the one in 2017? And I kind of touched on this already. The first point is that in 2016, I'd sort of done some research that showed that a lot of the demand and a lot of the acceleration was largely driven by investors who were buying houses in the suburbs to rent them out. And today's market is very different. The demand we're seeing is largely from end users. Again, this is anecdotal. It's very hard to measure investor demand real time. But it's mainly driven by end users. And there's a lot of demand in the suburbs for a couple of reasons. I mean, firstly, the demand was strong even before the pandemic. And what happened with the pandemic is after the lockdowns, it actually sort of supercharged the demand for houses in the suburbs for a couple of reasons. Number one, a lot of the active buyers who were in the market kind of changed their strategy and decided all of a sudden that they didn't want a condo or an urban home. They wanted a house in the suburbs. They wanted something ideally detached, with more space for home offices, with more indoor and outdoor space for kids to play. And this was a big shift in their behavior. But the pandemic also created a whole new set of buyers who weren't actively looking for homes in the first quarter of the year. These were people who lived downtown and just suddenly decided to move out of the city. So this basically accelerated demand for homes in the suburbs, which really created these, we see these bidding wars of houses getting 20 and 30 and 40 offers. Now, the other thing that's fueling demand is that interest rates have plummeted. I mean, in early 2020, home buyers were getting mortgages for just under 3%. Today, they're getting a mortgage for about 1.5%. And that's having a significant impact, obviously, on buyer behaviors and people wanting to kind of take on a mortgage because mortgage rates are so cheap right now. Now, the other key factor that's big difference between this trend and the last one is how quickly house prices are accelerating. So when we think about how long did it take the market to go from house prices appreciating from just single digits, 6, 7, 8% per year to over 30%, in 2016, it took the market about 25 months to go from house prices rising from single digits to over 30%. Whereas this time, house price, we went from basically single digit price growth to over 30% in 8 months, which is an unbelievably fast rate of growth. I mean, I talked about at the start of this video, how house prices have increased 16% from November alone. And it's this rapid acceleration in house prices that's actually bringing in a different type of investor from what we've seen in 2016 and 17, and that is house flippers. And now when I talk about house flippers, I don't mean the types of flippers that you'd see on HGTV, people buying a home, a fixer-upper, renovating it, and then flipping it for a profit. I'm talking about people who are buying homes, doing absolutely nothing to them, and then selling them 6 or 9 or slightly longer months later for hundreds of thousands of dollars more than what they bought the house for, without doing any work to them. And again, this is only possible because house prices have been accelerating so rapidly. Now, I will say that a lot of the flippers that we've been seeing, I mean, if you follow me on Twitter, I posted examples of these types of transactions, and there's tons of them. I do think that the majority of these people who've been flipping houses so far have come about these massive windfalls of hundreds of thousands of dollars, largely by accident. I don't think many of these people who intended to just buy and flip without doing any work. In some cases, we could see the data and they intended to rent it, couldn't rent it, and then just flipped it, and it just happened. The house had gone up significantly. So I think largely these people have come across these big gains by accident. But I think this is just the start of it. Obviously, we have to keep an eye on this dynamic. And right now, they are a relatively small percentage of the market. About 6% of the transactions in January were basically or listings, I should say, are properties that were bought in 2020. And that compares to just 4% a year ago. But my instinct is that we're likely going to see this increase in the months ahead. And I think it's going to increase for a couple of reasons. I mean, number one, we basically had a lot of people making a lot of money in a short period of time. And when you have that, that's sort of the first ingredient that attracts way more investors. And the best way to think about this is to let's look at how economist Robert Shiller described some of the behavioral dynamics that go on during a housing bubble. I'll read it out. We'll read it out. So he describes bubbles and irrational exuberance by saying, this is a situation which news of price increases spurs investor enthusiasm, which spreads by psychological contagion from person to person, in the process amplifying stories that might justify the price increase and bringing in larger and larger classes of investors who, despite doubts about the real value of the investment, are drawn to it partly through envy of other successes and partly through a gambler's excitement. And I think this is the other thing that makes this possible, that we could start seeing way more people jumping into the market trying to make these quick gains because they've seen other people do it and they have proof of that success. And the other last thing I'll say that might motivate investors to jump in is that government policy today is completely different from what it was in the past. I mean, normally governments don't want to see rapid acceleration in house prices and housing bubbles. And this time around, things seem quite different. So if we look at CMHC's sort of thoughts on the market, in December, they posted a report that looked at Toronto's housing market. And I'll just kind of post up the summary of their results here. They concluded in December that there's a very low risk of price acceleration, overvaluation, and overheating in Toronto's housing market. I mean, this is just stunning, of course, because a month later, suburban house prices were up over 35%. So CMHC doesn't appear to be concerned that house prices are rising this rapidly. And the message from the Bank of Canada is the same. They're not concerned about prices rising this rapidly. And they're largely not concerned by it because they feel that this is end users, so it doesn't matter. They should only be concerned if it's investors who are driving this demand. And the concerning thing, of course, is, and I think what might fuel investors' confidence, is that not only are government policymakers, largely is supportive of the acceleration in house prices. And I should slow down and say that they're largely supportive of this because this is really, rising house prices has been driving Canada's economy for years. I mean, rising house prices makes everybody feel richer, makes everyone want to spend a little bit more. If they rack up tons of debt in 5 years, they could just refinance it into their home because their home's gone up $300,000. And this is sort of the recipe that they're trying to use to get us out of a recession. And I think this is kind of leaving investors, at least the investors I talk to, very confident that this is a great time to be buying, because not only are policymakers pushing prices forward, they've been very clear that if the economy slows down, which includes the housing market, they have tons of policy tools available to keep it going. I mean, what could they do? There's tons of things they could do. They were planning on scaling back the stress test, which they didn't do during the pandemic. So the second the market starts to cool down, they could sort of go ahead with the changes that were planned, which would basically ease up debt, allow people to borrow more, which creates more demand. They could increase amortization periods. They could lower rates. There's so many things that governments can do to stimulate more demand. Which I think is leaving investors confident that, if you're going to invest in a housing bubble, you may as well invest in the one that's being fueled by the government on the way up, and the one that they'll just throw every policy tool at to prevent from falling in the future. And I think that's one big difference between this recent bubble and the one that we had in 2017. So how's the bubble going to end? This is obviously a tough question. The reality is, nobody knows. When I called the bubble last time in 2016, I just pointed out that it was a bubble. I couldn't predict when it was going to fall. It could have gone for another year. It was just a coincidence it fell when it did. So we don't know when it's going to end. But I'll kind of unpack some of the possible scenarios that might happen over the next year and things to keep an eye out for. So the first big question, of course, I think most home buyers are worried about is if house prices are going to crash in 2021. And my instinct is that that's very, very unlikely to happen. If we think about how housing bubbles fall and deflate, economist Paul Krugman had this great line where he said, housing bubbles don't end with a pop, but with a hiss. And what he means by that is housing bubbles rarely just pop and crash. It's rare to see house prices just plummet quickly. Usually house prices or housing bubbles unwind slowly. And the first signs of this unwinding is a decline in demand, an increase in inventory, and then gradually over time, we start to see prices fall. And right now, the reality is that the market is so far into seller's market territory that even if new listings doubled overnight, that wouldn't be enough to cool the market. It would probably just take us from a market where prices are going up 30% to 15%. So I think it's unlikely we're going to see a crash this year, especially if you combine this with the fact that governments don't want prices to fall and will probably do everything they can to sort of stimulate demand. Now, the one caveat to that, of course, is if for whatever reason we happen to see a cooling in the market in the Toronto suburbs alone, while the rest of the country is booming. In that case, our markets probably were on our own. It's unlikely the government's going to do something to sort of prop up Toronto's housing market, because doing so would potentially overstimulate the rest of the other markets. Now, so if a sudden crash is unlikely to happen, what is likely to happen? So in the best case scenario, what's going to happen likely is that as we head into the spring market, we're going to see more inventory. January, February tends to be the most competitive market because that's when people start their home search, which means it has the highest number of buyers in the market and the fewest listings. So we're going to see more listings hit the market in the spring, which is going to help take some heat out of the market. I don't think that's going to be enough to really cool things down to a more balanced level. We would somehow have to see a decline in demand to sort of bring the market back to a balanced level. And who knows what could cause the decline in demand? Decline in demand can happen at any minute. If confidence from buyers wears out, if there's buyer fatigue, if a lot of buyers just decide to hit pause in the market, or if economic conditions change and people are a little bit more cautious or pessimistic about the market. So it's tough to say when and if buyer demand will cool down, but we would need some decline in demand to bring us back to a more balanced market where prices are not rising 30% a year, but a more balanced rate. And hopefully, if we were to hit that point, the government wouldn't feel the needs to overstimulate the market again, as long as prices are keep rising. Now, to me, that's kind of the best case scenario. I don't know how likely it is. I personally think prices are probably going to keep going up in double digits, at least in the next 6 months. But ideally, something cools it down. Now, if that's kind of the best case scenario, what's the worst case scenario? And for me, the worst case scenario is if we see acceleration in demand from people flipping homes in the suburbs. And I kind of touched on this earlier. These are people who buy, hold on to the property, and then just basically sell them 6 or 9 months later without doing anything to them. This would be terrible, because this is the type of investor that is far worse than the investors we saw 4 or 5 years ago in the suburbs who are just buying and holding and renting. Those investors are at least long term. These types of investors are far more speculative. They're short term, and they're terrible for housing markets, because what ends up happening is if they end up rushing into the market, you got to imagine that they basically create more demand for the market, which pushes house prices up even higher. And then their gains end up becoming a self-fulfilling prophecy, at least in the short term, until things turn around. And ends up pushing house prices up far more rapidly and higher than they otherwise should be. And my concern is that we have a lot of ingredients to kind of make that possible in Toronto. I mean, we have homeowners with tons of availability of cheap money at their disposal. They're very overconfident that house prices can only increase in Toronto. And then they're overconfident that our government's going to do everything in their power to prevent a decline. So my concern is that we're going to see an acceleration in these types of investors. And if we do, that would be problematic because those types of speculative bubbles usually don't end very well. And that's definitely one thing we're going to have to keep an eye out for. Now, in terms of keeping an eye on the market, if you're actively looking, I'll say there are kind of 2 key things that I'm going to be keeping an eye out for in the months ahead. And the first one is looking at how house prices are changing from month to month. And again, I think I mentioned at the beginning, we don't typically compare price changes month over month because there are seasonal differences in the types of homes that are selling that might skew the averages. But in a market that's moving very quickly, we have to keep an eye on this, because the problem when we compare year over year changes is that for the next 3 or 4 months, even if prices don't change, let's just say all the heat has come out of the market and prices are flat and no one's paying crazy prices anymore. They're just paying at today's prices, which are still quite high, but they're not bidding them up as high as they were. So even if prices stay flat, the year over year change is still going to be 30+% compared to last year, because we're comparing today's elevated prices to last year's much lower prices. So this is where we need to be cautious when looking at year over year changes, because the data can be misleading. And this is where looking at how the market is changing on a month over month basis can be very helpful. The same way we did from November to January, and we saw that house prices increased 16% over the span of 2 months. Well, if we still keep seeing that type of momentum and that type of trend, it'll certainly be very alarming and will not be a positive sign for the market. And hopefully we don't see that and things level off in the near future would be ideal. So looking at how prices are changing from month over month is going to be a very important metric to keep an eye on. The second important metric to keep an eye on, of course, is, are we seeing more flippers in the market? Now, I'm going to be looking at kind of the data to quantify this, and we'll report on them in future reports. But even if you're active in the market, you can keep an eye on this yourself. I mean, if you're browsing houses online, basically you want to look at the entire sales history of the house. I mean, if you're looking on realtor.ca, they don't have sale prices. You can go to our website, velocity.com, and log in, and you'll basically see the entire sales history of the house. And that will basically let you know when was this house last purchased. And if it was purchased 6 or 9 or 12 months ago, this is someone who's basically just flipping the home. Now, we're not concerned as much about people who are renovating and flipping. I mean, those people are at least investing money into the home. We're more concerned about people who are just purely speculatively flipping and not doing anything to the house. So if you start to see more and more of these types of properties as you're browsing homes, that's a good indication that more and more people are doing it. The other way, of course, and it may sound silly, but it is to actually just listen to stories from friends. And this is really, the more you hear people talking about potentially doing this and making money from flipping, I mean, what you end up hearing from friends and anecdotally and word of mouth is effectively, and why I put a lot of value to this is the type of information that economists oftentimes try to understand months and years later through surveys. But on the ground, we can see what people are doing. And the more you talk to people and the more you hear people who want to basically flip homes because they know someone who's made a lot of money, this is a very alarming sign, and certainly basically a clue that this momentum is picking up. And we should certainly be very cautious of this if you're starting to see these types of dynamics. I hope you found this video helpful. If you have any questions, please post them below or shoot me an email at askjohn@movesmartly.com.